With the Augusta Rule, we know that we have heard this all over social media. And sometimes our clients send this over to us because all they hear is tax free. You get a big tax break for renting out your home. But before we get started, I know we have a few new members in our community. Want to properly introduce myself. Welcome. My name is Nadia Rodriguez. I am an active CPA out of the city of Dallas, Texas. Been in the business for over 15 years. I think I'm even closer to the 20-year mark, which is pretty exciting. And so I've been having my solo tax practice. It's just me. I do get help from my husband. He still doesn't prepare tax returns, but he helps a lot in the back end office. I have usually worked with corporations. I just left a big corporation, Fortune 500, about 4 months ago. It's getting close to the 4-month anniversary where I jumped ship and now I fully run my tax practice full time. But also, I have initiated our community here. The Nadia CPA Inner Circle is the community that I did found that's made especially for tax pros that come together because we want to learn from each other. And we're sometimes maybe in the early stages of our career, or we might be more experienced, but we're all coming together to share our learnings. And I also founded the Tax Training Academy. That's the academy that hosts more advanced master classes for entity returns, individual returns, tax planning, education. But that is what my passion is. I love to bring education to the tax pro community and share my knowledge and learn from you as well. So welcome today to our session. This Augusta Rule is, like I said, all over social media, but let's take it from the very beginning, because what do we know about our tax law here in the US? Our general rule is that all income is taxable, unless you can find a code section within our tax law that says otherwise. Because we know that technically, if we find money on the floor, that's going to be taxable, unless there's some kind of code section that says otherwise. So if we look over at the foundations of Code Section 280A. Now, do I know how many code sections we have? We have more than we can count. There's thousands of code sections that we have, and then we have subsections, and then we have regulations. So if we can see here a hierarchy, we have our U.S. code law at the very top, covers laws on enforcement for justice, different types of laws, but we do have one section, which is Title 26, that covers our Internal Revenue Code. That's our tax law right there. And within it, it's then broken down into subtitles. And we see subtitle A is one of the subtitles, and we have several chapters. But if we start diving down into chapter 1, and then subchapter B. Subchapter B computes the taxable income. It tells us there what is taxable income. And like I said, the general rule is going to start off right away and say everything is taxable income. But as we start diving into subchapter B, we start finding part 4, items that are not deductible. What can we not deduct against our taxable income? And we run across section 280A. That's the Internal Revenue Code section that talks about disallowance of certain expenses in connection with the business use of our home. It's our personal residence. We can't take any deductions against it. That's the general rule. Again, you'll learn this with the tax law. A lot of general rules, but then we have to start digging deep into those exceptions, those subsections. And that's how we come to subsection G. There's a special rule for certain rental use of our homes. It's kind of hidden. As you can see, it takes you a while to get there, but there is a subsection that talks about the exclusion of income when we rent our home. Nobody really knows this rule as the 280AG code section, but they know it as the Augusta Rule. So what is the Augusta Rule? Why is it called the Augusta Rule? It originated back in the city of Augusta, where they were holding the Masters golf tournament. And of course, the people that can afford to have homes around this golf area, they were renting out their homes to press, to players, to audience that wanted to come to these golfing events. And as they were renting them, they didn't really like that they had to follow the general rule of all of that income that they were getting from renting their homes had to be taxable. And so, usually what happens with our tax law? Usually we have lobbyists. We have groups that go in and try to get these tax law passed over, which is subsections of excluding tax income or making some income taxable or not taxable. Well, we had a group that went in and fought for this, and Congress approved it. they approved the 280AG, which is now part of our tax law, where it allows a short term occasional rental without having to pay tax. But of course, everything we know about the tax law, when it comes with amazing benefits like this, there's going to be rules, there's going to be requirements that we must follow in order to benefit from such a thing of not paying tax on a certain type of income. And so this allows the exclusion of income from brief rentals. And what do we mean by brief rentals and rentals of what? And it gets more into the granular of defining. And again, with the tax law, we have to really pay attention to the details because that's what's going to get us in trouble and make all of our income taxable when we're renting our home. We talk about the dwelling unit. What do we have to have? What can we rent out in order for that income, that rent income that we're receiving, to be excluded from our tax? Well, it has to be first a dwelling unit. What does a dwelling unit even mean? We're going to talk about what it means, but it has to be what they call a dwelling unit. It has to be rented for 14 days or less. You can rent it for 1 day, 2 days, 3 days, 14 days. But if you rent it for the 15th day during that year, you no longer can exclude that income from your taxable income. And you actually have to rent it, right? You can't just pretend like you rented it and have somebody gift you money and call it rent. We're going to go into those requirements and how important it is to meet the requirements. But first, let's really dive into what does the tax code say when it comes to dwelling unit? What can we call a dwelling unit? Well, first, it has to be a residence that is used personally, according to this section. It includes houses, apartments, mobile homes, even boats, vacation homes. And of course, with vacation homes, we need to make sure that we meet some of these tests and with all the others. But usually, when you talk about your personal residence, you've been in it for a long time. You've been living in it, using it as your personal residence. But if you own a second home that you go on vacations and you use that home for a while, then that's when we have to make sure that we're meeting this use test. It also includes adjacent structures. So, like if you have a personal residence, you have a separate garage, it's part of your dwelling unit, right? It's that whole residence is your dwelling unit. It does exclude, of course, hotels, motels, inns. We know that that's not really a personal residence. So the dwelling unit, we need to make sure that it is treated as a residence. And how do we classify it as a resident? If we have our principal residence, but then a vacation home, how would it fall under the dwelling unit definitions for this code section? If the owner uses it personally for a number of days that is greater than 14 days, and the greater of either 14 days or 10% of the number of days of the year that the unit is rented. First, we need to go into that classification to even say it is a dwelling unit. But remember, there's several requirements for the Augusta Rule. It being a dwelling unit, classified as a dwelling unit, is one. So if we look at an example for a vacation home, Mary, she rents out her lake house for 180 days at fair market value. She uses personally for 20 days. So first we have to apply that test, right? The use test. So if we compare the personal use days of 20 days that she's using it to the greater of either 14 days or 10% of the rental days, which is, we know 180 days of rental, then 10% times 180 days is 18 days. And so the greater of those two is 18 days, but she used it 20 days. We have met that test. She met it. She used it personally for more than these, either the 14 days or 10% of the fair market value of the rent, or the fair market, or the fair value, the fair rental days is what I'm saying. And then we go into step two, right? The personal use. This is where I'm showing it is treated as a dwelling unit, as a personal residence. But of course, the Augusta Rule, we're only talking about 14 days. In Mary's example, she rented it out for 180 days. We can't apply the Augusta Rule. We're only applying that Augusta Rule here in this example when we talk about just defining what a dwelling unit is, what a personal residence is under the code section 288. So when we do have the Augusta Rule, we're renting it, remember, not more than 14 days. It's not more than 14 days or less. There is income that we can exclude. Of course, we cannot take deductions for that income that we're using, right? Since we're not including it as income, as taxable income, we're not going to double dip and take expenses that maybe we hosted a business meeting at our office and we had to maybe pay for the rental or for the utilities those 14 days. We can't deduct anything against the income that comes from the rental of an Augusta Rule of 14 days or less. So yes, it's great for those high rents. You're probably going to be paying that rental for the rental if you're renting out your home to either a business or either a tenant or somebody that's going to a special event close to your home for less than 14 days. For you, it's amazing if you can rent it really high because all of that income will not be taxable. So if we have Jason as an example, he rents his home for 10 days during a city festival. He charges $1,000 a day. That makes it $10,000 total of taxable, of what you would think taxable income is. But since it's rented less than the 15 days, he rented it only for 10 days, he can exclude the full $10,000 from his tax return. It's not taxable income. So he does not need to report it, but again, he can't deduct the use of water, the use of the electricity for those days that they were rented. But hey, I'd rather go down the road of excluding $10,000 of taxable income, right? Where do we step into the strategy, a business strategy? Because yes, a home that's maybe close to a football stadium and you decide to rent it out, go for it. Again, as long as it's less than the 14 days. They rent it probably just for game day, the day before or after. Exclude that from your taxable income. But when we step into business strategies, right, we have our clients that are small business owners, and when we're advising them on how they can reduce that taxable income, here's where it comes into a strategy. Well, we have the owner that rents their own personal home to their business to host maybe board meetings, planning retreats, client events. I have a client who's renting out their home for a Christmas party for their employees. The business can actually deduct that rent, the rent that they're paying that business owner for the use of their personal residence. The owner gets to exclude that under the Augusta Rule, under Code Section 280A, subsection G. But the home, we know the rules, right? It has to be used personally, used for the resident and the owner of this home. It has to be actually used for business, not just a paper transaction. There has to be a purpose of why the business is renting the home from the owner. And of course, the same rule again, limited to only 14 days per year. It doesn't have to be 14 consecutive days. It could be one day a month. That's 12 months, 12 days for the whole year. We're under the 14 days. So if we look at another example, we have Sarah. She owns an S corporation. The S corporation holds 12 monthly meetings at her residence. Again, it's once a month meeting. She invites her employees, maybe business clients. We're holding some kind of business related event at our home. And so the S corporation pays her $1,500 a month for that one monthly meeting. In total, that's $18,000 a year. Of course, for this point, I do say this exceeds if this exceeds the 14-day, which I think I have here a typo, right? It's 12 monthly meetings, but if it were to exceed the 14 days, then the entire amount, the entire 18,000 does become taxable to Sarah. And how do we fix that? We limit the use to only 14 days. We make sure that it doesn't go past the 14 days. And of course, we see here at the very bottom documentation. And we're going to learn later on during the presentation how documentation is key. We can't just come up with a number and say that's how we're going to charge for rent. When it comes to the S Corp, again, this is where I say if we're renting our business, we're renting our home to our business or to another business that we are related to in some way. That's where the IRS really wants to see the documentation, right? Because there could be issues of it being related party. Is this rent really the amount of rent that you would have paid, you as the business would have paid someone else to rent that space? It has to be according to the fair market value. And so John, if he does rent out his home to the C Corp, we're saying 10 days, $2,000 a day, the corporation, like we said in the examples, right? They get to deduct 20,000 as a rent expense. Why does it matter? Because it's bringing down that taxable income of that business. Now, if it's an S Corp, it's going to make that income flow down at a lower amount than it would have before. So now the homeowner gets to pocket 20,000 of tax-free income, and their profit that flows down to them from the S corporation is lower by 20,000. Again, critical, I keep on telling you, critical how documentation is required. It is needed for you to prove your case on how we came up with $2,000 a day or the amount that we're coming up with. And that's when we're going to go into documentation requirements and some of the common pitfalls. And we're going to look at an actual tax court case that happened when it came to documentation. For documentation, right? It seems like an amazing deal. Rent your home, have your client rent their home to their business and have them receive that rental income. Doesn't have to be taxable if it's under the 15 days, if it's rented for not more than 14 days. But again, documentation is required for us to substantiate that expense from the S Corp or from the business, and then tax-free income to the homeowner. Because again, the proof of burden falls on the taxpayer. The IRS will just come and say, prove to me that the 2,000 or the amount that you're charging for rent is a fair market value. Prove to me what was talked about during this meeting. So this is where we come into documentation requirements. Number one, a rental agreement or an invoice has to be drafted. There has to be some kind of legitimacy behind this, and it's proved with paper. You have to create a written rental agreement or an event memo, something between the business and the business owner, saying that they are agreeing to a certain price and it's based on a certain amount, and for how many days, how many hours are they renting this space for. And it should include the dates of use, the purpose of the rental, what is exactly it being used for. Like I said, with my client, they're using it for a Christmas employee event, a holiday event. Who attended? The rental rate based on the fair market value. And that's what we're going to talk about. How do you even find out what the rental fair market value is for that residence for the day that you're renting it? Because it might be a little bit higher in December versus in the month of February. How are you determining that fair market value of the rental? You need to document the time and the duration. Did you rent it for hours? Was it a business meeting that lasted 2 hours, 3 hours, or was it an entire day? Maybe you were renting it from morning to the very late night hours. Maybe because you're preparing your home for that holiday event, you have planners coming over, decorators, and then at the end you need the cleanup crew, right? But it's not going to be your home. You're not really using it as a residence because it's being rented over to your business. And a description of what space are you renting, right? Maybe you have a 2-story house. In the second story, you're not renting it. You're only letting this holiday party happen on the first story. And so we have to be very attention to detail and document everything on this rental agreement or a document that has these type of items. The fair market value support. Again, we can't just come up with a number that is convenient to us because it is income that is not subject to tax. Instead, what we're saying, the IRS will expect that the rental rate is reasonable and supportable. How are we coming up with that number? And some of the evidence we can look on Airbnb, VRBO, maybe those WeWork websites or the hotel conference rooms. How much are they charging for that same date, for that same space, to hold as many people as we need? The space, is it a big space to hold a big meeting, or is it maybe just a room where we need to have a conference with certain employees? How much is the rental rate going for those type of spaces? We need to look at maybe commercial spaces, rental rates, similar size locations. Of course, we're not saying we're going to look at rental spaces. If we are in Dallas, Texas, I'm not going to look at rental spaces out in Los Angeles, California, because those are completely different market rates. I have to look at wherever is my proximity of my home here in Dallas, Texas. We have to have written quotes or appraisals, right? We're going to have to print those reports from either Zillow or Rentometer is another website. You need to have the proof. And of course, what do we know about IRS audits? We cannot be recreating the evidence until we're in an audit. This documentation has to be done when we are renting the residence. Document those comps and the calculation, print pages, screenshots. The more documentation, the better your case will be. You have to also have a business purpose documentation. You have to say exactly what did you do? Was it a host? Were you hosting a holiday event for your employees at the end of the year? Were you having a meeting? What was discussed at that meeting? You need to have a note taker. Now with technology, you can have one of those softwares take notes for you, right? Photos, sign-in sheets, photos for sure. I can tell you this even when it comes to the home office deduction. Photos of that space that you're using as your home office is crucial because what happens if you end up moving from your residence? How can you prove the space that you were using exclusively for your business meeting or for your home office? Again, that's going to come because what do we know about IRS audits? That they don't happen a year, a month after. They usually happen 2 to almost 3 years after we have filed our tax return. And calendar invites, right? That you send special invitations for this specific board meeting that's going to happen, this specific holiday employee event that's going to happen. Keep your notes, keep your calendar invites, keep those confirming the business purpose. And so, yes, it confirms it was not just a social event. It's not just people coming together, but what's the business use? It's for the convenience of the employer hosting an event at their home. Payment record. Yeah, so the payment does have to happen, right? You can't, and it happens when you're renting the home. You cannot now say that in December, we are going to pretend like we rented our personal residence back in January, February, March, April. If there was never a transaction that happened, never a payment of a rent, never a written document that was dated as of those days, again, this is probably something that's going to be more popular now in December that holidays events are happening, right? Do you need to find a space that you get together with your employees to plan out the year, to set your goals for next year? It may be a space that can cater a bigger crowd, or maybe you can have somebody that's a chef that comes to your house and cooks a meal for you and your employees to make sure that you're planning out your next year goals. You need to have that business documentation and also the payment record that the payment actually was sent out. You can't just take an expense and not really transfer the money out of your business bank account to the homeowner employee or the owner of this business. And so, yes, the rent should be paid before the year end. Make sure that that is done, especially if we're renting it out on December 31st. We don't want to make that rent payment on January 1st, unless that's what we're doing. We're making that tax income excludable next year. And this year, what's going to happen? We are on a cash basis. If you, the owner, is receiving that cash today, January or December 31st, then you really have to take account into the timing of when we're making those payments. Then we go into the business, how we said, it deducts this on their tax form as just rents. There's a line specifically assigned to rent. And it's just like the rent that you pay on your commercial building for your rent space. Maybe you have other board meetings that you're hosting at conferences. You just bundle this up, the rent that you paid over to the homeowner, you bundle it up under the rent expense on your tax form. And so you need to make sure that it's reflected as a rent expense. It's not reflected as a wage expense, please, or like an other expense. Classify it as is. And there is no 1099 miscellaneous that has to be issued because the general rule, we know that a 1099 miscellaneous has to be issued when we pay rent. Of course, if whoever is receiving that rent is a corporation, then we don't issue the 1099. But if it's an individual, like the homeowner is, the general rule says you have to issue them this form, unless it has to do with the less than the 15-day rule, the Augusta Rule. Then at that point, we don't have to file the 1099 miscellaneous because it's not taxable income. Add that there. The common pitfalls, what can really get us in trouble when it comes to the Augusta Rule? Again, because this is one of the areas that is looked at closely because it's income that we're not paying tax on. So yes, the IRS is going to pay a little bit more attention to that and try to break the case. So if you are renting it for over 14 days, just know you no longer qualify for the Augusta Rule. All of that income is now subject to tax for the homeowner. There is no more business tax savings or tax savings for the individual homeowner. Unsubstantiated use. Yes, the IRS can deny a deduction and the exclusion. So not only do they deny the homeowner from excluding that income as taxable income, but then also that business. They can't take that deduction because we don't have documentation to prove that it was a ordinary, reasonable, and necessary business expense deduction. There's no proof of what was spoken about, what the meeting was for, or the event was for. Why do we have to rent that from the homeowner? The lack of the market support, that can really get you in trouble because again, it can be looked like as a tax scheme that we're doing. If we're saying we're going to rent our personal home to our business for 50 grand a day, how are we coming up with that number? And the not having a formal agreement on file. There's not a formal rental agreement on file. That also can get us into trouble and have the denial of the expense at the business level and the inclusion of the taxable income at the homeowner level. Renting out to your Schedule C business. That is not allowed. Yes, even if you have an LLC, but if you are a sole member LLC, we know that by default, you are a disregarded entity and you report your income and your expenses on your Schedule C. In order for this to work, it has to be a separate entity, which means that LLC can then elect to be an S corporation or elect to be taxed as a C corporation. It has to be something other than reported on your Schedule C. We are considered a disregarded entity, which means the IRS doesn't see us as separate from our personal tax return. So Schedule C businesses are not allowed to benefit from an Augusta Rule. If we look at the learnings from a court case, because I think this is really important for all of us, right? Even in our personal life, we all learn from our own mistakes, and it's life lessons that then we don't do again. And so that's what I like about tax court cases, looking at to see what this taxpayer was trying to do, how did they get in trouble, and how were they denied, so that we don't do the same thing. We have Roy versus Commissioner. So a little bit of context about this court case. The taxpayers, the Roys, they tried to use the Augusta Rule to exclude rental income from their business for the use of their personal residence. Well, the tax court disallowed the exclusion for these reasons. So let's go down the reasons of why they were not allowed to use the Augusta Rule. One, poor documentation. The Roys, they failed to provide sufficient records proving the nature of the rental, the number of days rented, the business use of the business purpose for the rental. And so, yes, the IRS then wasn't really believing that this was a true business expense. The lack of substantiated business use. Again, how we talked about documentation. The rental to their own business lacked clear economic substance or a documented business purposes. Of course, then that looks a little fishy and makes it like a disguised tax strategy rather than a legitimate transaction. Because one of the things that when we're applying tax strategies, the Augusta Rule is a tax strategy. But if we're not having the documentation of the fair market value of the rental agreement, of what purpose, business purpose was it that we were renting it out for, then yeah, it looks like we're just applying some kind of strategy to exclude some taxable income and to avoid some tax. The fair market value, the Roys also did not the fair market value. So this is interesting because the court did acknowledge that fair market value is not strictly required under our code section 280 AG, which is true, but they still flagged that, and the rent did seem to be unsupported, especially their related parties, which damaged the credibility, right? The fair market value is still, even though it's not specifically spelled out, it will definitely win the case. We can't come up at, even in court, they're not going to be able to allow a huge amount of rental expense without having that support. And just like the support that we have for any other business expense. There's no proof of that 14-day limit. The taxpayers could not prove that they stayed within the 14 days. They just had a rental expense on the books. They didn't really say what days, hours, what was the timing, what was this rent paid for. And so the IRS can disregard these type of transactions. The number one lesson is lack of documentation, lack of proof, where we are proving that this is a business purpose of us renting the personal residence to our business. So, additional caution for employers: deductions are not allowed if the employee rents the home to the employer for the use of performing services. Think about a home office, right? We're using our home office for our business. We can't say that we are renting it to our business for the use of performing administrative tasks or for the use of an office. That falls under the home office deduction. If we have an S corporation, we know we have the accountable plan that we can reimburse ourselves for the home office deduction. But we can't put that under the Augusta rule saying that for 14 days we're going to use it as an office and we're charging rent for that. There has to be, that's one of the reasons we can't, right? There is no really business purpose. We can't rent it for a home office. And so, what are the audit triggers too? Repeated high value deductions with no documentation. You see how important it is to have documentation. I think I was telling another group that I'm helping a client with an audit, and documentation is key. If you have ever heard of the IDRs, that's a documentation request that the auditor sends to you of everything they want to see for your expenses, receipts, canceled checks, contracts. Documentation is key. So if you have those related party transactions between the owner of the business and the business that they own, the documentation is what will win your case. But we talk about documentation and we see that maybe it is time consuming, right? But it's time that we want to spend helping our clients, and we can build this under a tax advisory service. It's not something that we're going to be able to help them with on April 15. And we might mention a strategy of Augusta Rule, but it does take a follow up. It does take us to sit with our clients and explain the ins and outs about an Augusta Rule and how they can plan ahead to plan out those meetings, plan out those holiday events, those special anniversary events for the business at their home. What business purpose can we use our home for and rent it not more than 14 days? Because that we're going to be able to take a tax expense at the business level and don't have to claim that as taxable income at the individual level. So how much time would you spend on doing this documentation? As much as it's needed to make sure that we feel comfortable signing off on a return where our client would be able to defend their case. But with that, I'm going to introduce our guest today. David Carson. He is the owner and he has created an amazing software, 280taxbreak.com. And so I'll have David also introduce himself and also talk to us about his amazing product, which what I say right now, time is valued. It's valuable for us. Time is money. And how can we leverage today's technology so that we are not doing the manual work for our clients? Because unless our clients are really going to spend the time on doing this research, it's something that we are most likely going to get hired to do with them and do for them. But with that, I'm going to pass it over to Dave to show us his product.
I come from an IT background and I had an over 20-year IT career. Um, my wife has a accounting firm here in Houston, Texas, and I saw the need when I was talking to her about Augusta for more documentation, for more compliance. And I saw how many different processes were being used. Some people use Excel, some people use pen and paper, some people use Zillow. It's all over the board and it's very audit problematic, in my opinion. So, given all of this, I said, hey, we can solve this with some software. And I went ahead and created it. For the sake of time, because we are all time limited here, I'm just going to go ahead and jump right into the demo. um, Augusta, as Nadia outlined, is a very powerful tax deduction. The problem is documentation in many cases, and the problem is really being IRS resistant. You're never going to be IRS proof, but if you have good documentation that shows when, where, and why you made a certain decision, and that business owner is active in performing Augusta and why these meetings were held, then you can really resist an audit. You're never going to be audit proof, of course, but you can certainly be resistant and certainly win your case if you have the documentation. So, for the sake of time, I went ahead and chose a location, and it takes about 5 or 10 minutes. But what my platform does is once you enter a new case, which is each customer, the location you put in their business location or their home. In this case, you would put their home address, and then in about 5 or 10 minutes, you get a nice executive summary like the following. I'm hoping everybody can see that okay. And you can see I chose a location here in Dallas, and this actually gives you the date, time, when it was pulled, etc. So when the IRS is asking, well, how did you arrive at these rates? Well, here's a nice summary as well. There's a minimum, maximum, and average for each different event type. We allow events per event pricing per hour, meaning if you have a large event space, such as this one in the example for 20 people, obviously the rate's going to be higher than for a 10-person meeting. So if you had a big Christmas party, for example, and it's a legitimate business use, and you've discussed some business there, and you've documented all of that, obviously that's going to be a higher rate if you bring in the entire company versus, let's say, you just bring in the CEO and a small group. So that being said, you could put in a different rate, and this was generated earlier, just about an hour ago. I'm going to jump right into what I call the end user dashboard. The end user, is everybody seeing that across? Okay, let me share that. Voila. Um, the end user is the business owner. Rather than muddy the waters and try to confuse everybody, the roles are very simple. There's the end user and the tax pro. And the tax pro, because of Augusta being potentially abused, has a secondary review process in this. So the goal is you hand this off to your business customer. You've invited them to the platform. Well, of course, you signed up as a customer. You've invited them to the platform. That counts as one case. Our pricing is very straightforward. It's $299 a year for up to 5 cases. What Nadia did not really delve into much is as a billable amount, this can be a la carte. An Augusta preparation can be $500 plus. So as you're preparing taxes, when I was generating this, I wanted to generate a platform that can help grow small tax pros. And also, I ideally wanted to have an ROI immediately. And once you bill and complete one Augusta case, the rest of this would be it'd be pure income from there on out. And you have a nice ROI from day one. So I'm going to go through the gamification that I created on this. Nobody likes to do paperwork. Nobody likes to come back and say, yes, these were all the events over the prior year, why I held them, when they were held, and whom they were held with. So I went ahead and gamified it. So as the business owner is continuing here, they just perform the interview process. And the interview process will immediately show them this is my tax free income. And so it's going to default to the current date minus a year. And we're going to say we had a 9 to 5 event.
Quick question. Do you happen to have color paper? Do we have color
Yeah.
paper? Do you happen to have? It's
I-
okay if you.
I'm not quite hearing this question. It's not coming across.
Oh, sorry, that was somebody's mic was off, but we're good.
Okay. Okay. So looking over this, let's just say I bring in my CEO and a small team. Let's say it's somewhere between 70 and 150 an hour. And to be audit resistant, here's all of the data of when I pulled it. So as I'm going through and thinking about prior year and all of the events, well, we had normal monthly meetings, and then in addition, let's say we had a Christmas party, and the Christmas party was obviously a little bit bigger. So I'm going to be able to justify both something like $120 an hour for an average rate, and then maybe 150 to 175 or so an hour for a larger venue. So that being said, so I'm going to stay, let's say about 140. We had a board meeting, And if there's a different reason, I can do that. So I'm just going to say, Nadia, George, and Dave are on this meeting. I'm obviously abbreviating this, but this is just for the sake of the demo here. So I'm just going to go to the next event. As you can see, immediately you can see the tax-free income that the business owner is going through and they're going to receive. So that being said, if I ever need to reference back to that PDF, I can just click right here and I can reference back to that PDF. So I'm just going to go through and show you both the end user side, which is the business owner, and then the tax pro as well. So you can see as your client is progressing where they're at, and you can see kind of help manage that process. So I'm just going through as we're continuing, and you're seeing the dollar value here drive up. And that's part of why I chose Augusta. It's a great tax deduction. I mean, really, how many people are business owners and have meetings? It's pretty straightforward. Um, Documenting it, of course, is key, which is what we're doing as we're going. So, also another point, because most meetings are reoccurring and most meetings are kind of templates of each other, I have just been clicking through quickly on this, but this is basically copying and pasting the prior event to the next event. So as I'm just going through and choosing the dates, I'll show you a mistake here, for example. Uh-oh. So I've already had a date here, and you can see the prior events above. So I'm going to go ahead and just continue on, and we're going to say, okay, here's our dates and each event. And also, of course, you cannot enter 15 events on my platform. It just says, sorry, that's it. Into the road there. So as you can see, here we are midway through the year, and we've already got a huge portion of tax-free income coming. So if I'm the business owner and I'm documenting this and I say, well, wait a minute, Dave didn't attend this one. My better half, Andre, attended this one. I can add or remove attendees here. But as you can see, it's just going to copy from event to event to event because most events are reoccurring. So the secondary review is what's going to continue and be the next step. I'm going to delve into that here, and I'm going to show you the tax pro side next. But in under 5 minutes for your business owner, they can get this done pretty quickly. And actually, all they need at the end of the year is the notes of the meeting. You can certainly do other and outline a paragraph here. That's going to come across to you as well as the tax pro. So you have a good view as to who attended, why, and then you'll also see the rate here. So you could say, okay, that's great, that's reasonable. As the tax pro, you also receive a copy of this PDF. So you can see and audit, and as you're looking at this case, say, okay, that checks out, that would pass an IRS smell test. And wait a minute, that looks a little fishy. So as you can see, we're at our 12th event. We've done monthly meetings. Let's just say the 15th of, well, about the 16th of last year, we had a business party. And because the business party had more attendees, we're going to go up in our hourly rate a little bit. And voila. And we're going to have a whole bunch of other people. And really just adding these and removing them is very simple. You just X out. So I'm going to go ahead and save that. And as you can see, we had a nice little jump there. I'm going to say, in addition, we're at our 14th event right now. Let's go ahead and I'll just create a secondary meeting here in December. And we're at back to 140, 9 to 5. Just because I want to show you, you literally cannot, voila, you cannot do more than 14 events. It's literally limited. So I'm going to save and finish at this point, which kicks off some processes. Basically, that in the entirety is what you would see as a business owner. Uh, it's documented all of the events when they occurred, why they occurred. You've got a good fair market lease, and this is what you're going to see as the tax pro. Well, this is what the end user would see: a nice event summary and all of the tax-free income. Next step is in the tax pro's hands, which is the secondary review. So as the tax pro, now you're seeing both sides of this. You're seeing both the end user, which uh, is the business owner, and then you're seeing the tax pro side as well, because I've basically just tied both emails together on my account. If so, you're seeing both ends of this, both as the business owner would see it, as well as um, the business, as well as the tax pro. So I can modify this if I see something wrong with this, but I can look at the summary here, and as you can see, well, let me zoom in a little bit. Here we have the current status, when it was started, when it was finished, the status, the hourly rate. We allow up to 3 different business locations or business addresses. So if the owner had a vacation home, for example, it's not uncommon for a business owner to have a vacation home, and let's say they do special events there. So we can accommodate that as well as their normal home. Here's all of the events, and of course, it's a little bit abbreviated because I just, for the sake of time, was not putting in full names, of course. But as you can see, we copied forward on all the events very simply until I went ahead and canceled and added in a new attendee, which was copying forward. We have our business party here, and I didn't put in a lot of notes. And then as far as to why, but you could certainly add a lot of notes there. This is also tying in the hourly rate, so you can see it once again if you wanted to reference back to it to say, well, how did Dave arrive at that dollar amount? So if all looks good, which just for the sake of time, all is good, I can modify that if I wanted to and say, wait a minute, Mr. Business Owner, you went a little crazy there, but let's go ahead and accept it. And so here is the tax pro side, and you can see here. And the wonderful side of this is if you wanted to talk to a prospective customer and say, oh, great, you run meetings, you're an S Corp. Are you familiar with the Augusta Rule? And sorry, tongue stuck there. You make your client familiar with that. You familiarize them with that. You can easily come to this dashboard. This is your tax dashboard. And to start a new client, it's just literally this, and putting their business name, their email, their home location that they perform the Augusta meetings at. You could add more addresses as mentioned. But if you wanted to say to your customer, your prospective customer, hey, I've saved my customers X amount already with Augusta, this is cumulative for all of your customers. So as you're going along, you could say, well, I've generated $75,000, for example, in tax-free income from my customers. You can see the client's progress right here in each step as they're going along. And basically, all I would have to do at this point is go ahead and upload the lease agreement. And I've gone ahead and created template leases. And once I were to do this, this will basically complete the case. This is going to tie everything together. So as you have different clients in here, of course, you could see the status and see where they're at. Maybe they haven't completed the interview. I'm going to go ahead and upload one of my contracts here, which you could just, let me go ahead and,
Dave, does your program provide those templates, the
yes, I do.
contract? Oh,
I could certainly email these to you today, and it's state by state. So it's just a matter of filling out the fillable PDF and then saving it, and then you upload it here. So
okay, perfect.
I've created a 5-minute timer countdown. Let's just say, wait a minute, the customer changed their mind or whatnot. This is also to keep you from just having one case for ad infinitum for all of your clients. Because once you've generated the PDF, you basically have the documentation of what you need to be very IRS resistant at this point. So this is pretty much done at this point. Once the 5 minutes I've counted down, it'll continue on to 100%. And this is just showing you how easy I've tried to make it within the software for both the tax pro as well as the end user, the business owner. The business owner, as you can see, in under about 5 minutes, we went ahead and put in all of our events for the entire year of 2024. We made it IRS resistant because we had all of the data regarding how I arrived at that lease rate, and then what all the different events were, who was the attendee, and everything else. I put the power into the tax pro's hands because sometimes business owners get a little bit aggressive and may go ahead and say, my home is special and it's worth $250 an hour. If you can't really justify that, that makes life very difficult. But our whole platform is designed to go ahead and justify that. So, all of that being said, I just charge on the number of cases, and this is an annual price. And for 1 to 5 cases a year, it's $299 a year on upwards. The actual price per case is dropping with volume. And then if you have a number of customers, let's just say you've jumped into Augusta and you found out, hey, I've got 50 customers or 50 potential customers in my pool. Great. I have a large plan. It goes on to unlimited. We even get down to $30 a case. So I hope you see $30 or more, maybe even upwards of $60 per case of time savings in this, and being able to centralize your documentation, have it all in a nice, beautiful PDF that comes out at the end of the day. And basically, if you wanted to go up in an audit, if I put in full names here and maybe some data as far as to why, the reasons for each of these meetings, I think that any IRS auditor would have a hard time really fighting this. This is pretty audit resistant, in my opinion. And when you have a nice summary like this and your business owner sees it as well, they're going to see immediately, not necessarily their tax savings, but as Nadia mentioned, once they've gone ahead and drafted to themselves their own payment, and they start to see the tax savings, which you could calculate based upon their tax rate, which we can't see, they can see a lot of immediate savings. So I created this platform to make it easier for every tax pro, to make it better documented, and to basically gamify this so your business owner is not going to say, Nadia's asking for more documentation. That's such a headache. Well, when you're getting in there and you're starting to see 1,000, 2,000, or $10,000 of tax savings, I think just about anybody would love to do that. So the definition of insanity is doing the same thing over and over and expecting different results. And I think a lot of tax pros, unfortunately, at the end of busy season are a little bit insane. They've done the same things. They've maybe processed a few more 1040s, and that's that's kind of the extent of what they've done, and they've not really grown the business a huge amount. And that being said, it's sometimes difficult, but Augusta is very powerful in that regard, which is why uh, I really am a huge fan of it.
Thank you for sharing
Yes,
that.
this one is a group that got very aggressive on their hourly rates and started having $50,000 meetings, and
Mhm.
it got a little bit of crazy. But to say thank you to you guys, and to say thank you for inviting me to the circle, Nadia. I've created a coupon code for you guys. So if you do go ahead and say, great, I think 280taxbreak.com was a great time saver. I'd love to document all of my Augusta cases there. I'm giving you 15% off now and forever. So this is an annual renewal for every tax year. And this would be a continuing coupon code forever. So you would save 15% forever. Unfortunately, I do have to charge taxes on my service. Um, but if you like that coupon, it's right there. It's thank you dash Nadia Circle. And if you
Thank you.
sign up
Thank you
and
for sharing that.
use that coupon code, it does expire first of the next year. Maybe we'll talk again, but that will go ahead and save you for now and forever. So wanted to say thank you again, Nadia. It was a very good summary. I've seen people go sideways with Augusta in so many different ways, and I'm trying to prevent that with the software and the documentation therein.